Picture the moment right after you sign. You're sitting in your car in the driveway of a house you technically own, and your hands are shaking, not from excitement, from the number you just committed to. $2,700 a month minimum for the next 30 years. Your chest is tight and your phone screen still shows your bank balance. The gap between what left and what remains feels like staring down a cliff. That feeling, that quiet dread disguised as achievement, is the first thing nobody warned you about. Because everything leading up to this moment was a lie dressed in congratulations. Let's rewind to the lie itself. Somewhere along the way, you were told buying a home is for responsible adults. Your parents did it on a single income. Your mortgage broker smiled, ran your credit, and said you were approved. Some guy on social media told you he closed with virtually nothing down, and so you sat at your kitchen table at midnight scrolling through listings, doing mental math on a salary that suddenly felt like a cruel joke. Every house that wasn't visibly falling apart was priced at $500,000. Laminate countertops from 2003, beige carpet, fake wood paneling in the basement, and the listing agent with a straight face called it a starter home. You weren't crazy for thinking the numbers didn't add up. The numbers don't add up, and they haven't for years. But the entire machinery around you, the banks, the brokers, the cultural pressure, all of it exists to make you believe the problem is you, not the math. Here's the math they don't want you to sit with. The median household income in America hovers around $84,000. A $500,000 house is 6 times that annual income, 6 times. In any functioning financial universe, that ratio would set off alarms. But in dozens of markets right now, from Denver to Austin, or anything within commuting range of a major metro, $500,000 gets you 1,200 square feet. 3 bedrooms, 2 bathrooms, and a backyard roughly the size of a beach towel. That's the baseline. That's not luxury. That's the entry ticket. Now think about what it costs just to walk through the door. The traditional rule was 20% down. On a $500,000 home, that's $100,000 in cash. The median savings account in this country holds about $8,000. You're not slightly behind, you're $92,000 behind. And if you somehow manage to sock away 10% of your gross income, which almost no one actually does, you'd need 12 years to close that gap. 12 years, assuming prices freeze, which they absolutely will not. So you do what everyone tells you to do. You put down 5 or 10% instead. And the moment you do, you unlock a penalty called PMI, private mortgage insurance, a fee running $200 to $400 every month, for the privilege of not being rich enough. That money protects the bank, not you. The bank that already approved you, that decided you could handle this, they're charging you extra because even they suspect you probably can't. Let's say you scrape together $50,000 for a 10% down payment. That leaves you with a $450,000 loan. At current rates, somewhere between 6 and 7%. Your monthly payment for just principal and interest lands around $2,850. That number covers nothing else, not property taxes, which in most areas add another $4,000 to $8,000 a year. Roughly $500 a month if you're being generous. Not homeowners insurance, which has been climbing relentlessly. As insurers reprice risk across the country, you haven't turned on a single light, fixed a single leak, or mowed the lawn, and you're already staring at a massive monthly obligation, one that would make your parents' jaws hit the floor. This is where the old wisdom collapses completely. The advice you inherited, the assumptions you built your plans on, all of it was calibrated for a market that no longer exists. Approval was never the same thing as affordability. The bank doesn't care if you eat. The broker doesn't follow up 6 months later when the water heater dies. The culture that celebrates your closing day has nothing to say when you're lying awake doing subtraction in your head at 2 in the morning. And that silence, that gap between what you were promised and what the numbers actually demand, is exactly where the real damage begins. So let's do the math nobody at the closing table wants you to do. Let's start at the end, with the damage, and work backward to see exactly how it happens. Start with the gross income. $160,000 sounds powerful, until the federal government, the state government, and FICA take their cut, and a modest 401k contribution carves it down to roughly $9,500. in actual take-home pay every single month. That's the real number. That's the money they get to touch. Now subtract the house, because the mortgage is never just the mortgage. On a $500,000 home with 10% down, financed at 7%, the principal and interest alone eat $2,850 a month. Then property taxes show up, another $500. Homeowners insurance, depending on whether you're in a flood zone or fire zone or tornado alley, runs $250 to $350. Let's just call it $300. Then there's maintenance, the thing every buyer conveniently forgets. Until a water heater explodes at 11 o'clock on a Sunday night, the standard rule is 1% of the home's value per year. On a $500,000 house, that's $5,000 annually, which works out to about $417 a month. Set aside for things that will absolutely break. And because they put down less than 20%, tack on private mortgage insurance. Another $300 a month for the privilege of not having enough cash up front. Add it up, mortgage is $2,850, taxes are $500, insurance is $300, maintenance is $417, PMI is $300. Total monthly housing cost is $4,367, and that assumes nothing catastrophic happens, no new roof, no surprise HOA assessment, where the board decides to repave every sidewalk in the neighborhood and slides a $3,000 special assessment under your door. This household is spending 46% of their take-home pay on housing, not the recommended 28%, not even a stretched 35%. Nearly half of every dollar they earn disappears into a building before they've even fed themselves. Now here's the part that should make your stomach drop. Remember that 28% rule financial advisors talk about? The idea that your housing costs should stay under 28% of your income? Reverse engineer that with the real number. If $4,367 is only 28% of what you earn, you need a gross household income of roughly $187,000. Even if you use the looser 43% debt-to-income threshold, you still need to be clearing $150,000 annually, and only somewhere between 10 and 20% of all U.S. households reach that number. Which means, by any reasonable financial standard, 80% of American families cannot comfortably carry a $500,000 home. This is not an opinion, this is not pessimism. This is just arithmetic being merciless. So who's actually buying these houses? Some are dual-income households in high-paying fields. Some have family money filling the gap. And a significant number are doing exactly what the Johnsons are doing, stretching themselves so thin that a single medical emergency, a single layoff, or a single transmission failure on a Tuesday afternoon could collapse their entire financial architecture. They qualified for the loan, the bank said yes, and picture the woman at 2 in the morning sitting on the edge of her bed, phone calculator open, trying to figure out if she can replace her rear tires or gamble on bald rubber through another week of rain. She and her husband clear $160,000 a year. On paper, they did everything right. They got the $500,000 house, and now the house is eating them alive. That's the part nobody walks you through at the closing table. Not the monthly mortgage number, but the aftermath. The HVAC dies on a Tuesday in July, and suddenly there's a $5,000 bill staring at a savings account that hasn't recovered from the last emergency. Someone clips your bumper in a parking lot, and you're putting the deductible on a credit card you swore you'd stop using. Your kid's orthodontist hands you a treatment plan, and you're financing teeth the same way you financed your sedan. Every single hit lands on a household that has zero margin left to absorb it. And this is the family making $160,000. Now slide that income down to $120,000. Slide it to $100,000. Slide it all the way to the actual U.S. median of $84,000. At that level, owning a $500,000 home isn't a stretch. It isn't even a gamble. It is arithmetic fiction. The numbers physically cannot close without a relative writing a check. A windfall nobody planned for, or a tolerance for financial freefall that would make an adrenaline junkie flinch. But here is where the real violence of this system reveals itself. None of the people profiting from the transaction have any reason to stop you. The seller lists at $500,000 because comparable sales justify it, The bank approves you at 43% debt to income, because technically the loan won't blow up on day one. The agent pushes you to the upper edge of your pre-approval, because a higher sale price means a bigger commission check. Every single party at that table gets paid when you sign. Not one gets paid to ask if you'll still be solvent in year 3. The machine is engineered to move you through a door, not to make sure you can keep the lights on once you're inside. And once you're inside, the door locks behind you. You cannot wake up 6 months later, realize this was a catastrophic mistake, and simply hand the keys back. Walking away means a cratered credit score, a vaporized down payment, and years of financial wreckage trailing you like exhaust. So people stay. They stay in houses they cannot afford. They stay in jobs they despise because they cannot risk a single paycheck gap. They watch their emergency fund drain to nothing, then watch their retirement contributions drop to zero, and they lie awake at night wondering why achieving the supposed American dream feels completely indistinguishable from drowning. Here is the number that should be painted on every for sale sign. For roughly 70 to 80% of American households, a $500,000 home is not affordable, not sustainably, not without accepting a degree of financial fragility. That would have been called irresponsible a generation ago. And this is not a character flaw. This is not about skipping lattes or grinding a side hustle until midnight. Home prices have surged roughly 400% since 1990. Median household income has climbed about 180% over the same window. That gap is not a budgeting problem. It is a structural fracture. You cannot discipline your way across a canyon that wide. You cannot manifest a lower interest rate. You cannot hustle your way into a down payment when rent already swallows 40% of your gross. So who actually benefits from the myth? That hard work and discipline will get you into that house? The lender collects interest for 30 years, and the agent collects a commission at close. The local government collects rising property taxes. The insurance company collects premiums that climb every renewal, and the homeowner, the person who supposedly built wealth, collects stress and deferred maintenance, and a net worth that barely moves after you subtract every dollar the house demanded along the way. There is no trophy for being house poor. There is no award ceremony for making your mortgage payment. While your kid's dental work sits on a credit card at 22%, the pride you felt the afternoon you got the keys evaporates. The first time you realize you cannot afford to fix what breaks. The real question was never whether a bank would approve you. The real question is whether that approval actually transfers wealth to you, or simply transfers your income to every institution standing between you and the deed. And when you finally sit down and run the honest numbers, the answer gets really uncomfortable fast. So now you know the numbers are ugly. You've seen the real cost broken down to the last dollar. You understand that the gap between what you earn and what a $500,000 house actually demands is not a crack you can paper over with optimism. The question becomes, what do you physically do with that knowledge tonight, tomorrow morning, or even this weekend? Because understanding a problem and changing your behavior are two completely different animals. One lives in your head and the other lives in your hands. Here's the move, and I need you to hear how small it is, because that is exactly the point. Open a blank spreadsheet or grab a piece of paper and write down every single recurring payment that leaves your account each month. Not from memory, but from your actual bank statements. Pull up the last 90 days of transactions and go line by line. The subscription you forgot about and the insurance premium that auto-renews. The second streaming service you added during a free trial in November, and then you just never canceled it. Every dollar that exits your life on autopilot, without you consciously choosing to spend it. Most people have never actually done this. They know roughly what their rent and car payment is, and then everything else lives in a fog they'd rather not look into. That fog is exactly where financial ruin hides, not in the big obvious expenses, but in the slow, silent bleed of $40 here, $12 there, 99 cents a month for cloud storage you haven't opened since the pandemic. Now compare that circled number to your take-home pay. Not your salary, not the gross figure on your offer letter that made you feel successful for about 15 minutes. Your actual post-tax, post-deduction lands in your checking account number. Subtract your fixed obligations like housing and transportation, food at the grocery store level, not the restaurant level. Whatever is left, that is your real margin. And for a disturbing number of people earning what society considers good money, that margin is somewhere between razor-thin and non-existent. If you're in that zone right now as a renter, buying a $500,000 house doesn't solve your problem. It just buries you under it. The second piece of this is even more tedious, and that is exactly how you know it works. Every Friday night, for 10 minutes, sit down and look at what you spent. Not to judge yourself, or spiral into guilt about the coffee, or the impulse purchase. You just need to look, like a mechanic checking the oil level on an engine, no emotion, just data. Did more money go out than you expected, and where did it go? Was it a conscious choice, or did it just happen? You do this for 6 consecutive Fridays, just 6, and something shifts in the back of your brain. You start noticing the spending in real time. Before it happens, not after. You catch yourself hovering over the checkout button and actually asking whether this purchase moves you closer to stability or further from it. That tiny friction, that half-second pause between impulse and action, is worth more than any financial guru's masterclass. This is the unsexy truth nobody wants to film a TikTok about. Wealth isn't built in a single dramatic decision. It's built in the boring, repetitive act of knowing exactly where your money goes, and making that knowledge impossible to ignore. The woman sitting on the edge of her bed at 2 a.m, with her phone calculator open, doesn't need a better investment strategy. She needs to know, down to the cent, what her life actually costs before she adds a mortgage to the pile. The guy convincing himself he'll pick up freelance work on weekends to cover the gap doesn't need a side hustle. He needs to see, in black and white, that his current spending already consumes every dollar he earns, and that adding a bigger housing payment on top of that isn't ambition. It's arithmetic headed straight for a wall. So before you tour another open house, before you get pre-approved, before you let a mortgage broker tell you what you can afford, do the boring thing, map the bleed, and find the margin. Sit with those numbers for 6 Friday nights in a row until they stop being abstract and start being reflexive. Because the people who actually build wealth over decades aren't the ones who bought the biggest house at the youngest age. They're the ones who understood their own cash flow so deeply that no lender, no agent, and no cultural pressure could talk them into a payment that would slowly strangle them. And that understanding doesn't start with a grand plan. It starts with a spreadsheet and a Friday night, and the willingness to be honest about a number most people would rather never see. That discipline, as boring and small as it sounds, is the thing that separates the person who owns a home comfortably from the person who technically owns a home but hasn't slept through the night in 3 years. And it raises a harder question, one that cuts deeper than any monthly budget review ever could. Here is the part that nobody in this transaction wants you to hear, so I am going to say it slowly. You are allowed to walk away. You are allowed to close the Zillow tab, delete the mortgage calculator app, look your well-meaning parents in the eye and say, "Not right now." No one hands you a trophy for signing paperwork that turns every Tuesday night into a quiet panic attack about whether the water heater will survive another winter. No one throws a parade because you stretched into a payment. That leaves $11 of breathing room between you and a missed bill. The bank does not care if you eat rice and beans for 3 years straight. The real estate agent does not lose sleep when your emergency fund sits at 0 because the roof started leaking 4 months after closing. Every single person in that closing room profits the moment your pen hits the page, and not a single one of them loses a dime. When you lie awake at 2 a.m. doing math on the ceiling, and if you are sitting here right now feeling like you have failed some fundamental checkpoint of adult life because the numbers will not bend in your favor, I need you to shift the lens for a second. Picture 2 versions of yourself 5 years from now. The first version stretched, signed, and bought the house at the top of what the lender approved. That version has equity on paper, sure, but also a savings account that never climbs above 4 figures, a retirement contribution that got paused twice, and a persistent knot in the stomach every time an unexpected expense appears. Right there on the credit card statement. The second version waited, rented something modest, and invested the difference. Built a 6-month emergency cushion and watched the market from the sidelines. With cash in hand and options wide open. Maybe in year 3 the market corrected, and that same house came back at 380 instead of 500. Maybe income doubled and the math finally made sense without acrobatics. Maybe a job opportunity opened in a city where 500,000 buys a real home with a real yard, instead of a glorified apartment with a mortgage attached. The second version did not give up on ownership. That version gave up on the delusion that a bank's willingness to approve a loan is the same thing as your ability to survive one. Those are two catastrophically different calculations, and the housing industry has spent decades blurring the line between them on purpose. The housing market will keep pretending these prices are normal. Lenders will keep approving loans that have no business existing. Agents will keep smiling and telling you it's always a great time to buy, because for them it always is. But you do not owe your financial survival to their commission structure. Sometimes the most sophisticated move on the entire board is recognizing that the game in front of you is not built for you to win, and quietly stepping back from the table with your money still in your pocket.